Alli, let's start with you on ADP, on some of the anecdotal evidence about workforce reductions. Today it's Uber. It's leading to this narrative among some that you might reopen, but there will be a permanent scar on the economy that's going to take longer than we think to heal. What do you think?
I think that you're right. And I think that what we're seeing is this consistent deviation in the story that you're hearing from Wall Street and financial professionals versus what you're hearing from Main Street and business owners. And these unemployment numbers, some of the earnings reports that we've seen all really highlight that. And so what that says to me is that, yes, the market is the leading indicator of when we've bottomed. So if we have bottomed, then we're going to see a really difficult Q3 and hopefully back into, a really difficult Q2 and then a beginning of a recovery in Q3. The one thing that I have to say, though, is that the conversation that I've been having largely with clients is focused on, A, what will the shape of the curve be, and B, market timing. And those aren't particularly constructive conversations to have. So I would rather have my clients focus on what does a post-COVID world look like and how do you invest for that? And a post-COVID world, I think we can all agree, is more digital, more local, and more indebted. So let's invest in those areas that are going to benefit, whether we're talking 3, 6, 9 months out.
So you're not looking to dive back into things that would be traditionally cyclical. Your inclination is to stick more with the stay-at-home basket that's worked so well so far this year?
I wouldn't say it's to stay at home with the cyclical basket, but certainly on the digital front, we expect not that we're going to see the 100, 200% growth that we've seen in some things like streaming, et cetera. But we do expect that the trend that was there, that was going to be consistently seen and drive growth over the next 10 years, is going to continue to grow 15 to 20%. In the event that we have bottomed, in the event that we do start to see some different rhetoric and different data around numbers, around consumption, around earnings, then yes, we might get back into some of the sort of safer pro-cyclicals. But in, en masse right now, we prefer credit to the equity market. We think it's more closely pricing in our downside scenario and our base case scenario, and pricing in some things that I think are probably not likely to occur, like the energy high yield market is pricing in a 40 to 50% default rate. It's going to be bad, but I don't think it's going to be that bad.
Darrell, that's interesting, and it's a point that gets repeated a lot, that there's better opportunity in credit in private markets than there are in equities right now. Where does that leave your standard 60-40 stock, somebody who wants to be in equities right now?
Yeah, I think it's a good point, Carl, and we would definitely like to favor credit here over equities. We think the equity market on its retrenchment rally has probably gone a little too far. The risk-return trade-off here is not terribly great. We would favor, for example, on the S&P, something more in the 2,600 range if we get back down to it. I think the big question here as we think about the reopening and the recovery is the Fed and Congress get really high marks for solving for liquidity in the capital markets. They did an exceptional job. Liquidity became unfrozen, and we're back to semi-normal functioning markets, if not normal. Solvency remains the second phase of this, right? And we're starting to see some companies, particularly the weaker ones, fail and go into bankruptcy. And so we expect that trend to continue. The real trend and question for the market here then is the third phase, which is profitability. How do we return to some level of profitability that is, copacetic with 2019? And unfortunately, investors right now appear to be faced with a difficult choice of choosing between unusually high multiples in the equity markets or fighting that Fed and fighting the Fed's liquidity. So we think you've got a classic bull-bear standoff happening right now. You're caught from a technical standpoint right between the 30 or 200-day moving average upside resistance and the downward trending 50-day downward support. And the next couple of weeks will be really key here where markets break higher or lower.
Yeah. Two questions on that, Darrell. One is, what does a profitability outlook mean when half of companies aren't giving you any guidance in the near term? And if we're focusing more on profitability rather than solvency now. What does that do to the Fed put? Fed's not going to come to the rescue if S&P earnings come down markedly as long as markets are functioning, right?
Correct. And that's your point's an excellent one to the second question, which is the Fed can solve for liquidity. It can help with solvency and keeping some of the players afloat for periods of time. It won't bring the customers back to the table. And when they do, you have to ask the questions of, will the customers, are they going to be reluctant to return? Those who will return, will they spend less than they did prior? And also you have to take into account that serving them now requires a higher cost to serve them. So profitability, I think, is what the markets should be focused in on here. Up to this point, it's been all about liquidity and solvency. And so I think as we look forward, that's why we think at 28.70 this morning, the risk return on an upside to maybe 3,000 isn't great. But if we start focusing on that weaker profitability or challenge around bringing back profitability, then I think you've got some downside here probably to equities. When you look at first quarter earnings numbers, they continue to slip on 2021 estimates. If you read the transcripts and listen to CEOs, their guidance and their commentary suggests investors need to prepare for a long, slow, and uneven recovery. Probably the one sector that really jumps out that's been the outlier has been healthcare. They've been a bright spot in this reporting season so far at the sector level.